Well, good afternoon, everybody. I'm Rick Edelman. Thanks so much for joining us today in this conversation. Bitcoin is clearly the big winner out of the election, isn't it, from November? There's an awful lot going on with the new Trump administration, as we all know. But clearly, crypto is the dominant winner. And that's why we've seen the incredible increase in price of Bitcoin since the president was elected back in November. And it is raising a lot of attention, a lot of interest among investors. But one of the things that people are so focused on is Bitcoin's volatility. In this conversation today, we're going to show you how to harness that volatility, turn that into an advantage as part of your portfolio diversification. And to help us do that, I'm very happy to welcome onto this webinar Matt Kaufman. He's the SVP and head of ETFs at Calamos. Matt, it's great to have you with us on this conversation today.
Thanks, Rick. Good to be here. Appreciate it.
Matt has been in this business for 20 plus years, and like so many in the crypto space, Matt began in TradFi. He started out in the world of ETFs, UITs, and so on, and made the big leap into Bitcoin and blockchain technology. And Matt, talk about that journey of when did you get familiar with, knowledgeable about Bitcoin? What made you and your company decide that you needed to have solutions for Bitcoin on behalf of investors?
Yeah, great question. Hopefully, we'll spend the next several minutes and get people to the conclusion that it's more of a bridge than maybe jumping into the abyss here. But I started my career at PowerShares in the early days of ETFs. I think we were the third ETF provider in the market. In the ETF world, you need what used to be called a permission slip to launch ETFs, exemptive relief. Now there's standardized rules around that. But back then, you'd have to spend a couple $1 million and 18 months of legal work. Well, we got our exemptive relief from a firm who already had it. Will remain nameless today, but they basically said all the good indexes are taken. The S&P is taken, the Qs are taken, and the Dow is taken. There's nothing left to do in the ETF world. Here you go. Have at it. And so we built a big business there. I was younger and learned a lot about building ETFs and innovation as well. We built about 120 ETFs in a pretty short time period before ultimately selling PowerShares to Invesco now. So you see Invesco QQQ and all these other products in the market. From there, I went to an actuarial consulting firm, which makes about as much sense saying that out loud today as it did back then. We went over to a firm called Milliman, and we were building funds out of the hedging strategies that the company was running on the balance sheets of large life insurance companies. So the chairman said, I have all of the actuaries I need. We need people who know how to build funds. We want to build risk managed funds. So that business grew pretty rapidly. We built a lot of products for life insurance companies, fixed indexed annuities. RILAs were a structured annuity, came out back then. I know this is more of an ETF discussion, but what we saw back then in that really low rate environment was the value that you could deliver through the insurance company was pretty low when rates were low. Banks had the same issue, couldn't deliver much on the way of upside on their structured products. What we uncovered at Milliman, I was the head of product development at the time, was that you could deliver those types of outcomes, buffers and caps and protection outside of the insurance wrapper. We don't need a balance sheet from an insurance company or a bank to deliver that. And so we built some intellectual property that delivered buffers and caps on the S&P 500 that ultimately became the defined outcome ETF space. That's pretty large today. It's about a $60-70 billion space. There's about 10, 11 providers in the market. I came over to Calamos 2 years ago. Calamos is one of the largest risk managers in the world. We do a lot by way of alternative strategies. We're the largest convertible bond manager in the world as well. That convert space was a little sleepy for a while, has made a comeback of sorts, largely through these micro strat converts, which, relative to Bitcoin here are pretty timely. We have a fund, CVRT, is an ETF that owns some of those micro strat converts, and it's about the only way to access them in the ETF market today. But thinking about Calamos on the whole, we're a very stable risk manager. We've been doing this for about 50 years. And, I'm not going to be the one to blow that up. We're going to be around for a lot longer. And the things that we look at as in terms of risk managing assets, you need things that are liquid. You need liquid options markets. You need very big assets. And so, usually you'd see these on the S&P 500. You see protection on NASDAQ 100, Russell 2000. Believe it or not, Bitcoin checks all those boxes now. Seventh largest asset in the world, 1.9 trillion market cap. We've got options now that we've got those ETPs out in the market, more than 100 billion in assets in those exchange traded products. They trade about $2 to $5 billion every single day. So we now have the ability to deliver options strategies on Bitcoin. And we're risk managers. We're going to build the risk managed versions. You can use options for a lot of different things. We are building risk managed exposure to Bitcoin. So that's what we've delivered. On January 22nd, we launched the first protected Bitcoin ETF. It has 100% protection over a 1-year outcome period. So similar to the way a defined outcome fund might work, you buy in on day one at $25 and you get the upside of Bitcoin to a cap rate. There's no free lunch. You get a cap of about 11.65% with no downside risk over that outcome period. And then yesterday we launched 2 more in the suite. We launched a 90% protection level, or you could think of it as a 10 floor, and that cap was about 29%. And then we launched an 80% protection, or 20% at risk. That cap rate was 51.5%. So just to wrap that line of thinking up, we've now delivered Bitcoin with a safety net. That's the line that I like to use. You can choose where to set that safety net. No downside at risk, 10% at risk, or 20% at risk. So we're seeing a lot of financial advisors find value in this because they can now deliver protected Bitcoin exposure in a way that's going to keep the client safe, keep the advisor safe, and ultimately keep the firm they work for safe.
And not merely safe, but really giving investors an opportunity to participate in an environment where they otherwise may have simply not been comfortable. So this is going to be a pretty dynamic conversation, and you'll have an opportunity to ask your questions as well. Many of the folks who registered for this webinar have already submitted questions in advance. I'm going to pepper Matt with those as well as we go. If you come up with questions based on what you hear, just go into the chat box here on Zoom, type in your question. I'll be curating those as we go. And when I see something that looks really apropos and relevant to our conversation, I'll be sure to throw that in as well.
And Rick, you can confirm I have not seen these questions yet. So this will be a fun live experience.
Yeah, and we'll see how well you do, off the cuff without any prep to do that. There's no question that Bitcoin is probably the most talked about investment of the day for all the obvious reasons. Bitcoin had one hell of a run and recently. I mean, it's the best performing asset in history, as we know, going from 15 years ago to $2 trillion market cap today. Just the last 2 years, in 2023, 2024, it made like 150% in each of those 2 years. And the most talked about asset, when Donald Trump is on the campaign trail and he says he wants to make the United States the crypto capital of the planet, and he's now talking about a Bitcoin reserve for the federal government, and on and on and on. All of his economic appointees are strong crypto supporters. This is getting a lot of attention by a lot of consumers, a lot of investors. But at the same time, everybody is really familiar with the incredible volatility that Bitcoin has experienced along the way. Not just the incredible downturns, of 70% losses in a year, but the scams and the frauds that have existed as well over time. So within all of that, Matt, explain what you think has been contributing to the incredible performance of the past 2 years, and tell us what you think is going to happen to Bitcoin's performance over the next several years.
Yeah, I think what you said about the rise in prices, absolutely been true. I think we've seen some demand come from the launch of those spot Bitcoin ETPs. That has been, something that's been in the works for several years. If you remember the Winklevoss twins that filed for that application, was it maybe 10, 15 years ago?
It was 2013. They filed the first ETF application.
Yeah. And that took about that long, another 10 years, it took Grayscale to actually sue the SEC to open the gate for all of those spot Bitcoin ETPs. I don't know that maybe they anticipated it, but I don't know that Grayscale expected all of the flood of other ETF providers to come into the market and then undercut the price. I've never seen a price war in an ETF happen so quickly before those products even came to market. You can now get that beta Bitcoin exposure in a really not to say tax efficient, but in a cheap way. So we saw BlackRock come into market, iBits here. We've got the Fidelity product that did very well. There's 11 spot Bitcoin ETPs in the market today, more than 100 billion in assets. And that wasn't just people selling out of their crypto wallets and buying the ETF instead. I think we talked about safety and regulation. When you buy something as an ETF wrapper, that's a regulated investment instrument. So you have SEC oversight. You have custodians inside, holding those Bitcoin. And so there's a little bit of perceived safety there.
Well, it's really true, Matt, that there absolutely is. I mean, we know that Bitcoin suffers from two major perception problems. One is am I going to get caught up in a fraud? And second, the volatility of the asset. Might I lose a lot of money? When you buy the ETF, a Bitcoin ETF, because it's a regulated product under the auspices of the SEC, FINRA, and the state securities regulators, you don't have to worry about the fraud element. You still have the investment risk, but at least you can be pretty comfortable that your advisor is not going to steal your money, or some crook is going to steal your money. And that has made, for the first time, an opportunity for investors via their financial advisors to engage. And I think you're absolutely right. This is why a lot of that $100 billion came from people sitting on the sidelines.
I think you're right. And we're seeing that in some of the survey work that we're looking at as well. We've seen adoption from financial advisors go from about 11% to a whopping 22%. It doubled, but it's not anywhere near advisors' adoption of stocks or bonds or commodities. But what we are seeing is nearly 100% of those financial advisors are getting asked about Bitcoin as an asset, and it's forcing those advisors to have a strategy. It's forcing the platforms to have a strategy. And so I think that's a lot of where the protected Bitcoin versions can come into play.
And you're exactly right, because everybody is now acknowledging, when I say everybody, I'm talking about the financial advisor community. We're recognizing it's now safe to get in the water in terms of fraud risk. The ETFs make it really easy to say yes. The compliance departments are willing to say yes to this. The investment committees are willing to say yes, because everybody's familiar with the ETF wrapper. And we know what they are. We're familiar with them. Investors are familiar with them. You can do it in an ordinary brokerage account. You can easily rebalance and tax loss harvest. You can do dollar cost averaging. You can do tax reporting. It's simple and easy, just like any ETF. And it eliminates that big concern over opening a Coinbase account or, just all the cumbersome element of it. But still, that means you're left with the volatility risk and the notion that most investors really don't like a lot of volatility, and most advisors don't like to expose their clients to that volatility. So there's still the stigma. And that's been kind of the approach that Calamos has played, of saying, we're not going to deal with Bitcoin. We're going to deal with Bitcoin's volatility to try to make it more palatable for the ordinary investor. So elaborate on that for us a little bit, of exactly, you talked about the floor and the ceiling of the products, but talk about the mechanics of how that really works, and help investors and the advisors watching this really understand the inside operation of these products.
Yeah, Rick, I think you're right. I think a lot of investors have been on the sidelines. A lot of people have appreciated this remarkable growth in Bitcoin, but they're nervous. They're nervous about this epic level of volatility. They want to be able to participate in this growth, but in a way that works, maybe more for their, financial planning model. If a lot of these folks have financial advisors, they're working into a framework where they have to meet a risk tolerance that they have. And Bitcoin, really doesn't always meet that risk tolerance. Or if you look at the spot Bitcoin research today, a lot of large asset managers are saying maybe move 2 to 3% into Bitcoin, and they're suggesting to sell Mag 7 in order to get there. Well, I don't know any advisor that just has those 7 stocks laying around somewhere to say, okay, I can now sell those in order to get my Bitcoin exposure. They're usually selling Qs or they're selling SPY in order to get rid of that Mag 7, and you're throwing out the rest of the, the baby with the bathwater, so to speak, in order to do it. So you asked about mechanics. The way that we build this is, fairly simple. And one way that we talk about it is if I just give you $100 or we use 100% of the portfolio, we can recreate this experience of protected Bitcoin exposure. The largest holding is U.S. Treasury bonds, and these are zero coupon bonds. So they don't pay interest payments, but you buy them at a discount to their final maturity value. And so if we want to create something with 100% protection, I put $96 or 96% into zero coupon treasuries that will expire in 1 year, because I want to give you a 1 year outcome period. And I know that's going to accrete to 100. So that gives me $4 or 4% to work with. So that's my protection layer. I know that if Bitcoin goes away or goes down, I'm protected because I've got all of those treasuries. So now we have to create your Bitcoin exposure. So we're going to buy an at-the-money call. These are options contracts. We're buying an at-the-money call relative to Bitcoin. In this case, we buy options on the SIBO Bitcoin US ETF index. There's a few reasons that we use that index, largely because of capacity. It allows us to build a really big fund. So we buy an at-the-money call. That's expensive.
And you're using the $4 left over to do this.
Exactly. Yeah, exactly. But that option in particular costs about $25. It's very expensive. And so we have to sell off some upside. So we're selling an out of the money call in order to fund that purchase. And so we're going to sell off enough upside so that I can collect $21 of income. So I've spent 25, I collect 24. And the difference is that
you collect 21, you have 4 left.
Yeah. Yes, thank you. Appreciate that. So you collect 21, difference is that 4% or that $4 that my risk-free rate is going to accrete by. So best case scenario in that example, Bitcoin goes up 20%, you're going to collect that 11.65% cap rate over the outcome period. Worst case, Bitcoin goes down, or, let's say Bitcoin goes away. I don't think people will decide it shouldn't exist, but let's flip the lights off on Bitcoin. You're left with a portfolio of 100% in U.S. Treasury bonds.
Which means your return after 1 year is going to be somewhere between the original investment or a gain of 11%.
That's correct. That's for our 100% protection product. So you just step down with how much you put at risk. If you go to the 90% protection, you've got a 29% cap. And if you go to the 20% floor, the 80% protection, then you've got about a 51.5% cap rate. So the more you put at risk, the higher your upside opportunity.
So it would seem to me, and this is my bias, in my world as being a financial advisor for 40 years, it doesn't seem to me that people should really be paying a lot of attention to the zero risk fund. And I simply say that because if you're willing to invest in the stock market, which I would assume everybody looking at Bitcoin is already doing, that means they're willing to accept the risks of the stock market. And if you're willing to accept the risks of the stock market, you ought to be willing to accept a similar risk in Bitcoin.
Yeah.
So if you're willing to lose 10% in stocks, you ought to be willing to lose 10% in Bitcoin, which means you can give yourself more upside than just the 11%. You can go all the way to 28%. Or if you're willing to tolerate a 20% downturn, which, let's face it, the stock market did that a few years ago, that gives you the opportunity to make over 50% in Bitcoin. And a lot of people do think Bitcoin's going to rise dramatically. So why would you want to give away such massive upside potential, considering you're willing to have that exposure in the stock market anyway? Is my logic flawed anywhere?
It's not flawed. It's a great question. If I could flip that argument on its head, what are you doing with your cash? What are you doing with your bonds? Like let's say you buy an indexed CD, or you're buying a CD that's going to pay you a 4%, rate over the next year. What if you could tie that to Bitcoin? What if you could get 3 times the risk-free rate with no downside risk?
That's interesting.
Like, in other words, your portfolio growth.
Yeah. So in other words, instead of having money in the bank earning 2 or 3 or 4%, where you have no risk because it's in a bank account, if you put that into this zero risk fund, you're going to have the same guarantee. You're not going to lose money at the end of the year. You might not earn the 2 or 3 or 4%. So you're gambling that. You're giving up the potential of that return from a bank CD,
Right.
but you're also giving yourself the upside potential of 11%.
Exactly. Exactly.
That's an interesting idea. The only issue, though, Matt, right, is that you've got to be willing to be sure you're going to hold on to it for the full year term. You know,
Yeah.
in the bank CD, you can
That's right.
always liquidate. You keep the interest you've earned. You don't earn any further. But in
Correct.
your case, you just have to be willing that you're going to, if you bought a 1 year CD and you know you're going to keep it there for a year, barring a crisis,
Yeah.
then you just do this instead, and maybe you'll get 11% instead of 2%.
Yeah. Well, and there's a couple points there. If you buy that CD, when you take your money out, you're going to pay ordinary income tax on that growth.
Right.
If you put it into our ETFs, a majority of that growth is going to be capital. It's going to be tax deferred. So if you've held for longer than 1 year, most of that growth is going to be long-term capital gains. We'll have to distribute a little of that original issue discount. So you might get a 2 to 3% distribution, but a majority is going to be growth. So yeah, thinking out loud, like I've got a school bill coming due in 9 months. So I love that idea of getting 11% upside. That's a risk I'm willing to take. I've got the money for the tuition, but maybe I can make 11% on that.
So we're getting lots of questions, as you can imagine. This is really fascinating intellectual, philosophical conversation here. What happens? There's some of the questions people are asking. What happens if, because you said, for example, that it's a 1 year product. You launched the product, you said, for example, yesterday was one of the product launches. What if somebody doesn't buy it on the initial date you launched it? They buy it at some point during the year. What is the impact on the term of period? What's the, does
Yeah.
that floor and ceiling still apply?
Yeah, great question. So we won't dive too much into the weeds here, but we open the ETF on day one at $25. And we open and leave it in cash all day long for anybody who wants to get in and get that 100%, 90%, 80% protection level. And then we strike the cap at the end of that day. So if you buy in on day one, you can be sure you'll get that 100% protection level. Or anytime the NAV crosses back over its $25 mark is a great time to buy, because now you can get that same outcome over a shorter time period. But if you go to our website, go to calamos.com, you can plug in the ticker and you can see exactly what your upside is, how much protection you have, and how many days are left in that outcome period. So Bitcoin is up a little bit since yesterday. So now our protection level, instead of 90, might be around 89. But you'll still be able to get a good protection level, and you'll know what that is before you actually place a trade. So you'll be able to make that decision for yourself.
And then once you do buy, you've locked it in for the remainder of the fund's term. You're not starting a new clock at a year. You've got, maybe 9 months left out of that year, depending on when you've bought it.
That's right. We've taken this concept of a structured product or a fixed index annuity with a term, placed it on the exchange, got rid of all the counterparty risk. And so now you have a tremendous amount of liquidity. You can buy in, sell out anytime you want. So you can still get in at the beginning, get that outcome period performance, or there's some really interesting things you could do along the way too.
And Charles is asking, what's the expense ratio for these funds?
69 basis points.
Oh, that's like right in line with, typical stock, international funds, foreign funds, commodity funds. I mean, that's not,
Yeah, it is.
That's a highly competitive rate. I would have expected a higher rate than that, simply because of options trading.
Oh,
So,
sure. Yeah,
so
and
that's,
in the outcome-based space, we're on the cheaper end of the
yeah.
range. Mhm.
You'd mentioned that the zero risk fund, with a 0% loss and 11% cap, is a 1 year cycle. Uh, is that true of the other funds, the 80 and the 90 as well?
Yeah, these are all designed to deliver over a 1 year outcome period. That's pretty typical in the outcome-based ETF world. So we're going to launch these every quarter. If we see one take off and people like one over the other, we may fill in the months and launch monthly on the others. But every quarter, you'll be able to buy in to get that outcome period
Oh,
performance.
so in other words, if there's a lot of price movement in Bitcoin, you'll just launch a new fund so that you're resetting that floor and ceiling for everybody, so they don't have to wait
Yeah,
a whole year.
that's
And what
exactly.
happens at the end of the year? Does the investor have to do anything? And what if they don't?
Yeah, you don't have to do anything. You will not get your money back unless you sell. There is no distribution of your growth back to you. Again, there might be a small income distribution from those treasuries, but all of that growth is going to stay in the fund. So if you've earned 10% or 20%, let's say the NAV is at 100 and we grow to 120, your new outcome is going to be based off of that 120. We'll get a new upside cap rate, a new protection level, and a brand new outcome period. So that money will just grow and compound year over year.
And so you're just going to, redo, start over again with a new year cycle and just keep going
Exactly.
from there.
Yeah, the ETF won't close.
And now talk about what happens. We've talked about what happens if you buy during the year, but what happens if you sell during the year prior to that 1 year term expiration?
Yeah, so if Bitcoin is up, you're going to be capturing the upward movement of Bitcoin to a greater degree over time. So that's in the options world, that's called a delta. Your rate of capture is going to grow to 100% over that outcome period. So if Bitcoin's up really big early on, you may not be up all the way to your cap rate. It's designed to achieve over the outcome period. But let's say you're halfway through, you have a 30% cap and Bitcoin's up, 30, 40%, you might be up 20 to 25% halfway through. And so you could decide to lock in those gains. The other opportunity would be if Bitcoin has fallen and let's say you're in the 100% product and Bitcoin's down 20 or 30%, well, you've just avoided all that loss. And so you could now move into the April series and reset your starting point and capture any rebound that might happen. So there's some interesting ways to play this where you could theoretically avoid all the drawdown and then capture some of that rebound if it happens. And you think about the vol of Bitcoin, a lot of us have seen and talk about those studies. If you fall 50% in the market, you got to have 100% move in order to make all that up. Well, it's the same for Bitcoin, and that reality of a 50% drawdown is real. I mean, that's happened several times over the last 10 years. And so if you can avoid a lot of that and then capture some of the upside, it's a great opportunity to do that. If you're a student of history and you think we're going to correct in another 12 months and every fourth year you get that correction, I'm not predicting that, but if that's what you think, you could move into the protected version and, protect yourself that way.
So you have done this for Bitcoin and you've set floors at 0, 10, and 20%. Are you anticipating any additional, such as going to 30 or 40%, or doing this for other coins like Ethereum?
Yeah, as a 50-year-old risk manager, what we look at is there a liquid market to work from? S&P 500, NASDAQ 100. Is there an options market that's liquid? And can we build this, logically? And so, those three boxes are checked with Bitcoin. It's a really large asset. There's a liquid options marketplace we can work from. All the market makers can hedge themselves using IBIT and other ETPs in the marketplace. So that's why we can deliver this type of risk managed exposure to Bitcoin. We cannot reliably say the same thing for other, alternative type coins. If those boxes start to get checked, then I think it's an area we'll start to look at if the demand is there. But at this time, I can't reliably build, something with risk management in it. It reminds me, just kind of our philosophy around risk management. If you're building, something in technology, you can have it fail. You can build the beta version. I can give it to you. You're going to test it. I'm going to update it every 6 months. A couple apps might crash. Like you just can't do that in financial services. If it fails, you're dealing with people's life savings. And so you have to build something with security, innovate with security. So we spent the last, 10 months or so making sure that the ETP market was there, that Bitcoin was stable as an asset, very large, the options worked. And so we're at a point where we can reliably deliver this into the market. So it is an interesting thought experiment, but yeah, I would never build something that we would be comfortable, giving to my parents, I would say.
And that's a wonderful way of putting it. That, would you tell your mom to buy this? What you're also kind of reflecting here, Matt, you didn't say it explicitly, but I think implicitly in your comment is the fact that Bitcoin is, without question, the dominant digital asset in
Definitely.
blockchain technology. And it has such a lead over everything else because of the breadth and depth of ownership on a global basis, not just retail, but institutionally. It's really going to be hard for another coin to catch up. Because if somebody, and I'm thinking an institutional investor who wants to allocate to crypto for the first time due to the tailwinds we now have in the Trump administration here in the US, that odds are pretty high that investment committee and that board is going to say yes to Bitcoin
Hmm.
before they say yes to anything else. And that just means they're going to turn to the Bitcoin spot market, the Bitcoin options market, as opposed to any other coin or token.
I think that's right. Yeah, this is a well-established asset. As we go through due diligence processes with other platforms, they're seeing the value in being able to access this inside of a protected way, and doing it to Bitcoin, I think gives people a lot of comfort. Mhm.
So ordinarily, um, most in the crypto community are pretty bullish about the price of Bitcoin. The Trump administration has made it really clear of their support. We're seeing similar support in Congress, where now the majority of both parties are crypto supporters. And we are all excited about what's coming with new regulation, new legislation that provide rules of the road that everybody's been clamoring for and never got in the Biden administration and under Gary Gensler at the SEC. Those days are behind us. Everybody's pretty much excited about what's coming. And therefore, there's a pretty strong amount of bullish sentiment in the world of crypto. Uh, Talk about what you see and what Calamos is suggesting, what the future holds for the price of Bitcoin in the next year or two, and maybe the next 5 years or so, and how that correlates to how advisors should consider the use of these products in that limelight.
Yeah, I don't disagree. There is a lot of bullish sentiment. We've got Trump, looking at establishing a strategic Bitcoin reserve. We have other countries looking at doing the same. We've seen state treasury departments join some of our webinars looking at, ways to access Bitcoin. In particular, we've seen a lot of folks have that desire for upside opportunity, but their thesis is and policies, they cannot take on any balance sheet risk. And so it's not just an individual investor that wants to, shoot the moon on Bitcoin. There are very large institutions, who actually manage money in a way that they can't lose that much, or they can only lose a specific amount. And so there's a lot of applications there as well. I don't view, this as a limiting factor of just let's cap your upside and go for it. But rather it opens the whole portfolio up for how you want to access Bitcoin. You no longer just have to sell off some of your stock exposure, and maybe the ones that are actually flying high, Nvidia, Meta, Google, who wants to sell those and replace it with Bitcoin, when now you might be able to sell your high yield bonds or your safe money, maybe it's corporate bonds. And so the advisor, the way that they often will meet with their client, discern and determine what their risk tolerance is. Maybe you're a conservative investor or moderate investor. Now you have options in the portfolio to tie Bitcoin to your portfolio in a way that actually protects it. Last sentence here is, we've seen some advisors have crypto millionaires actually come into their office and say, I've made all this money in Bitcoin. I'm getting a little older. I've got a family. Like, I actually want to protect some of this wealth now. So, congratulations to you. You've done it. You identified this mega trend before anyone else. Now let's take that money and maybe diversify some of that. We're not going to give up all the crypto exposure, but maybe we're going to do it in a risk managed way so that you can still preserve those gains and take that into the future.
So let's elaborate on that point, because I think it's the most innovative of this entire Bitcoin conversation. Historically, and even at the present, Bitcoin's conversation has always been about the upside. The people who are buying Bitcoin are people who believe Bitcoin's going to continue not just to rise, but to dramatically outperform all the other asset classes. And this is why the allocation of a low single digit exposure in the portfolio is strongly recommended by a lot of folks in the marketplace. I'm one of them. And yet, there remains inherently the risk of the incredible volatility. And we can manage some of it away by rebalancing, but you still need a pretty strong stomach because Bitcoin can move 5, 10, 20% in a day. I mean, just look at the last week, for
Yeah, it
example.
happened.
And so that keeps some people out of the marketplace. Uh, your funds are creating an opportunity for people to say, it's safe to get in the water. You might not make all that much money, but on the other hand, you're not going to get hit by a tidal wave. And that can allow you to get exposure that you otherwise might not have, which I think is one pretty interesting perspective on this. But the real key that you're citing, Matt, is the use of assets that you would ordinarily consider the safest of your assets: government bonds, high yield bonds, corporate bonds, and the literal cash reserves you would have in a bank account. Now, first of all, elaborate and stress the true differences between doing a U.S. Treasury supported options trading fund like yours versus really somebody's money in a money market account or bank CD where it's FDIC insured. Elaborate on that, first of all, to keep everybody's compliance departments happy.
No, I get it. So yeah, let's just pretend like you had your money in a safe bond or a CD that's going to pay you 4% over the next year. That product all has an expiration date. And then at the end of that product's life, you're going to get that growth and it's going to be taxed at ordinary income rates. So let's say that turns into 2.7% at the end. So you're taking that 2.7, you're essentially turning that guaranteed rate in for the opportunity to earn the price performance of Bitcoin up to a cap of 11.65%. And then your downside risk is 69 basis points, the management fee of the ETF. So that gives you the opportunity to earn about 3 times the risk-free rate.
Well, I would add that you also have the risk that you're not earning the 2.7 that bank account was going to pay.
Correct. That would be your trade-off there. That's right. That's exactly right.
But net, you're still looking at a 2 or 3 or 4%, or 2 or 3 or 4x improvement in the return you're going to get.
Yeah, so it is a new way to think about it, but in terms of capital protected growth and the options available to people, Bitcoin is actually one of the best power sources available in the market because it goes up, like you said, faster than anything else in the market and often higher than anything else. Every 4th year you see that big drawdown, but you start to compound and roll those year over year, and that safe money is going to be doing a lot more for you than it would be sitting in a CD or something like that.
And it's worth pointing out that CD is FDIC insured. You can liquidate it at any time, and you may pay a penalty on the CD, but if it's a savings account, you're going to keep whatever interest you'd earned to date.
Well, the same is true for the ETFs. They're not FDIC insured, but what is your backstop? Your backstop is U.S. Treasury bonds. So
which you'd argue is even better than FDIC.
I would, yeah.
Yeah. And the taxation, if you hold that ETF, as you said, for a year or more, you're going to enjoy capital gains tax rates as opposed to ordinary income rates, which is half the cost. So you have that benefit as well.
That's right.
Talk about alternative ways that people can engage in market exposure that limit downside. I mean, as you mentioned at the top of this conversation, it isn't just Bitcoin. This is the latest entry. You've been doing this with other asset classes as well. So Bitcoin is kind of the natural next step for this. But talk about the other ways or other asset classes that you also make this available.
Yeah, I mean, Bitcoin was certainly an opportunity set now that we have the liquidity in the options market. And, Calamos was, pleased to be the first in the market with the protected Bitcoin ETF suite. As I came over to Calamos, interest rates were rising higher off of zero. If you remember back to our, insurance conversations, a lot of these are rate-driven products. If interest rates are at zero, the upside that you can deliver on the S&P goes down dramatically. But as I came over to Calamos, rates are going higher. They're 2, 3, 4, 5%. And people are now buying money markets again. They're buying CDs. They're chasing fixed indexed annuity rates or capital protected structured notes. And that space in the ETF world had really not been captured yet. And so that's what we did at Calamos. Last May, we launched the first 100% 1-year principal protected ETFs, where if you buy in again at that starting NAV, you'll get the upside to a broad equity market with no downside risk. And so we did that on the S&P 500, the NASDAQ 100, and the Russell 2000. Similar to our conversations, prior to this point, we're seeing a lot of folks move in on the equity side. They're using this for equity risk management. Maybe they're not tying all of their safe money to these types of products, but they want to de-risk equity exposure. So maybe you're holding 80% in S&P 500 and then 20% in the structured protection version. Well, now you've got 20% less downside risk, but 80% upside, and you're going to capture all of that zero to the cap rate. So people are using it that way. On the flip side, again, we're seeing institutions, we're seeing credit unions and insurance companies that can't take balance sheet risk, put money into these because they get better upside than they'll get in a lot of other places. Retirees is a big one, and say near and dear to my heart. There's 11,000 retirees hitting the market every single day. It's the most we've ever seen. You think about when Social Security was passed, 1 in 16 US citizens were retired. We are on a freight train going toward 1 in 4 United States citizens being of retirement age. That group has got to outpace inflation over time if they're going to rely on their portfolios to provide for themselves when they no longer work. This type of product set becomes less of a behavioral concern as you're younger, and it becomes more of a mathematical problem as you age, where if you withdraw from your portfolio when you hit volatile events, a lot of times you can get into a zone where you may never be able to recover. And so being able to tie your money to the equity markets now helps retirees outpace inflation. They don't have to rely on bonds, which are inversely correlated to rates, to do it. And it can really keep their portfolio value alive while they're in retirement. Like I said, my own parents are in their late 70s. They own the S&P 500 version of these. They get about 8% upside. They spend 4% of their money every year. My dad will say, I get to go bowling. All my buddies are watching their phones, watching the market. I really don't care. This is perfect for us, you know.
That's a really interesting way of looking at it. You basically, and I agree with everything you're saying. You're basically saying if you put your money in a super safe account, traditional kind of account where you're earning 2% a year, that is not going to keep pace with inflation over the rest of your retirement life. That's going to fail. So you might as well put it here instead, where you have the potential for earning 10, because you might not get it. You might not get the 10. You might end up at 0. You know, you won't lose money, but you might give up the 2, but the 2 isn't helping you. The 10 will. So
Correct.
you might as well try to get the 10, because guaranteed 2 is failure.
100%.
It's an interesting way of looking at it. Chris has asked an interesting question. I'm just going to read you the question here because he articulates it pretty well, or she does pretty well. Chris writes, the whole idea of investing in Bitcoin is to capture the volatility and, by doing so, experience the upside. Taking the upside and capping it at 11%, Chris writes, makes no sense, because 11% is pretty much what you'll get from the stock market. So why not, if all you're going to do is earn a max of 11%, why not just put the money into equities and call it a day? I'm kind of paraphrasing there, but
No, that's
so
great. Is Chris, right?
yes.
So to me, you're thinking about vol only on the upside. If you capture 11% from the S&P 500, you're basically saying that's the average, but you're looking at it in a distribution of returns. So if you look at the annual distribution of returns for the S&P 500, it looks like a bell, traditional bell. You got a lot centered around that 11%. You've got a lot of big fat tail risk. You know, maybe you're down 30 or 40, but you've also got some good upside years. So on average, you might get that. But where else can you get 11% risk free? Like, that's where you take the volatility away, but keep the upside. You know, in fact, I think what we're doing encapsulates your comment of, we are harnessing volatility and giving it to you back as an upside premium. So what is the risk-free premium we can give you for Bitcoin? It's 11.65% today. That's what you can get. Well, what is it if I take 10% risk? It's 30%, or 20% risk is 51%. So the cap rates go up with volatility. And that's a large reason the cap rates are so high, is because when you sell an out of the money call, you're selling volatility, you're collecting a vol premium. So if vol spikes in Bitcoin, let's say it goes to 110, 120, which we've seen, the cap rate's going to go higher. You're going to get a better cap rate when volatility goes higher. So in fact, we're doing what you said. We're capturing volatility and delivering all of that value back to you, but in a risk-controlled framework. Last sentence, if you look at the bell curve of the S&P, look at what the return distribution of Bitcoin looks like. It looks like a smile. It's inverted. It's all upside or all downside. It's 40% or more up. It's 40% or more down. There's nothing really in the middle. And so when you access Bitcoin, you know, from our perspective, you want to do it in a way that gives you good upside opportunity, 50, 51%, but cutting off the tail of those 50, 60, 70% drawdowns. And so I don't think you can talk about vol without recognizing the left side if you're going to talk about the right side.
Yeah. You talk a lot with financial advisors. What are they saying? Tell me what you're hearing within the advisory community. Generally speaking, they and their clients' attitudes about Bitcoin and the worries about volatility, and particularly their reaction to these product ideas.
We usually hear two things, when we think we might be onto something and we start to talk to advisors about this. They usually say, how is this possible? And why hasn't anyone else thought of this before? And we've heard that a lot with these types of products. We've gone through that $100 example, showing you exactly how to deliver it. A lot of the platforms have said, this is what we've been waiting for. We just don't feel comfortable accessing Bitcoin for the security measures you were talking about. Now there's spot Bitcoin. But a lot of firms do not want to expose their clients to 60, 70, 80 vol assets. But if they can do it in a way that matches their risk tolerance, you've now brought that into the traditional, now I'm talking TradFi again, into the traditional framework of portfolio management and financial advisory practices, which, these deliver right into that.
Let's see, additional questions. Can you do this in a Roth IRA or a deductible IRA?
Yeah, anywhere you can access ETFs, so like Schwab, Fidelity, a lot of broker-dealer platforms will have access to these as well. Some 401k platforms, aren't self-directed. They'll just expose you to mutual funds or collective trusts. So we're not in that space, but anywhere you can buy an ETF, you should be able to find us.
Peyton is asking if this is an ETF or an ETP. Is it 40 Act or 33 Act?
These are 40 Act products. The SIBO, we're getting in the weeds now. The SIBO Bitcoin index is considered an equity index. And so that's how we can build this as a 40 Act ETF.
Cody wants to know if, in theory, you could ladder these, say buy them on a quarterly basis.
Yeah, I think I saw another question that was a little more poignant that said, there's risk that the day before my outcome, Bitcoin falls and crashes and I lose all of my growth. So I think the first question answers the second. I would do a laddered version if that's your concern. You might need to wait until there's two of these out. So in April, you could buy both and then you'd have a diversified time experience there. So I think it's a great idea.
Andrew wants to know if there's a minimum purchase.
$25. That would be the cost of one share. I think it might be 25.10 now for the 20% protection. CBOJ, I think, still trading right around $25.
Jim wants to know if there's any duration risk to the treasuries that you're using.
No, we align the expiration of the treasuries with the maturity of the options. So our goal is for everything to mature right around that 1 year mark. If there's a couple day difference, then we'll just sit in cash for those couple days from the treasuries until they all hit the same point.
Eric's got a good observation. He's noted that Bitcoin's volatility is actually declining. If we, as you know, Matt, if we look at Bitcoin's volatility over the past several years, it's going down. And I think this is true as more and more own it, and especially institutional investors. That's a good thing. We're happy to see Bitcoin get a little more realistic compared to other asset classes. But his question is, if volatility continues to go down, will that have an impact on the floor and ceiling and the pricing?
It'll have a little bit of an impact, not a tremendous amount. I just was running some vol assumptions here. So, if vol is 80 today, you'll have about a 55-60% cap rate. I think when we struck, vol was about 55, and so your cap rate was about 51. So I'm just giving you real-time simulations here, and let's say vol goes to 25. Your cap rate might go down to in the low 40s, something like that. I'm just thinking out loud. So you'll see some drawdown, but not a lot. And I would say if you see vol go that low, you're probably not seeing 500% returns either on the upside.
Yeah, exactly. In other words, if Bitcoin's volatility goes to zero, this product no longer needs to exist.
Correct. Yeah,
but then at the same time, nobody needs to buy Bitcoin if the volatility goes to zero, it becomes a bank CD. So
yeah, I do think, not just saying this, but I do think we're kind of in a sweet spot now where maybe Bitcoin's not going to deliver that 200, 300, 400% return if vol is actually coming down. You have to think about the variability of upside and downside. So you can't have both. You can't think that Bitcoin's going up 1,000% with no volatility. Like, you
Yeah,
can't do that.
boy, that would be fun. It's really interesting when you look at people with these assumptions, and they assume that Bitcoin is at 100,000 today. And you've heard the predictions, right? Michael
Yeah.
Saylor thinks it's going to 5 million.
Yeah.
Kathy Wood says 1 million. I say it's going to grow to 500,000, but people assume it's going to be a straight line from
Correct.
100,000 to a million. It isn't going to be a straight line. It's going to be an incredible mountain range, and
Yeah.
people tend to forget that.
Yeah, you probably get this from clients time to time, and we hear it more of a funny anecdote. But if we had a nickel for every time someone said, like, it would be great if you could give me all the upside and none of the downside. That's what I'm really looking for.
Yeah, I'm looking for beer that tastes great and is less filling, right?
Yeah, yeah, there you go. There you go.
So Lou asks, Lou's just trying to really get his head around this. So his question is really well put. After a year, he says, and Bitcoin's up 8%, is my account up 8%?
Yes, you will be up 8%. Yeah, you'll be up appreciated the price of Bitcoin. You'll capture that 8%, and then we'll roll into a new set of options. And that new starting point will be based off of the appreciated value. That will be your new floor.
And if Bitcoin's up 11, you're up 11. But if Bitcoin's up 15, you're still only up 11.
Correct.
Got it. Okay. Um, let's see. I'm just running through all the questions. There's so many questions that are coming in here. Talk about the impact of the interest rates, because there's a lot of conversation about what the Fed is doing and Trump's attitude about interest rates, et cetera. What impact would rising or falling rates at the Fed have on the product?
So options-based strategies are pretty highly tied to interest rates, and they would be tied to the on the rate curve where your options life is. So if you have 1-year options, you're going to be pretty well tied to the 1-year risk-free rate. If you got a 3-year product, it's going to be at the 3-year rate. What we've seen historically as these interest rates have come down is we saw the short end of the curve come down. You saw the long end of the curve go up, 100 basis points or so. And it all pivoted right around that 2-year mark. So we didn't see much movement up or down from the 1 to 3-year rate. I think 1-year rate right now is about 4.2%. If you think about this relative to 100% products, you'll be able to get about twice the 1-year risk-free rate for the S&P, and it just goes up from there. So NASDAQ, be a little bit higher, maybe your cap rate's in the 9s, Russell's 9 to 10, and then Bitcoin about 12%. So you're getting about 3 times the risk-free rate. You'll always be better than that rate, because if you add up what makes up your cap rate for a principal protected product, it's risk-free rate, dividend yield if you have one, and then volatility. And so for Bitcoin, it's all risk-free rate and all volatility, and that spits out a pretty good cap. If you take that floor products, the 10 floor, well, because I'm exposed to the first 10%, I only have to put 86% of my money into treasuries. That frees up 10% to buy options with or to sell less with. And so that's why your cap rate goes up and up. So you're less exposed to interest rate risk with the 90 and the 80% products, because you don't have to buy as much treasuries. So that's how that works.
This is a really fascinating opportunity for advisors to evaluate the addition of Bitcoin to a client portfolio where they might ordinarily think the client isn't psychologically well suited to a volatile asset like Bitcoin, or just otherwise, dismissive of it. I think this is really worth considering, and not just as an allocation of Bitcoin, but your notion, Matt, of using the safe side of the portfolio, the either the bonds or even your cash, some of your cash reserves, as an alternative to those assets, because you're basically having your cake and eating it too. The only thing you're gambling, so to speak, is whether you might earn 2%, leaving it where it is, or potentially earning 11% as an alternative in a better tax factored environment. So there's a lot to think about here. There's a lot of opportunity, and I think that advisors are going to be reaching out to you, and investors as well. The best way, tell us, for people to learn more about these investment opportunities at Calamos is how?
Yeah, you could go to calamos.com. It's right on our homepage. You can dive into the ETFs, see where they're trading. We keep that pricing updated so you can know if you bought in exactly, right now, what your upside is, your protection level. Feel free to reach out to me directly. It's just mkaufman@calamos.com. There's wholesalers and we have external counterparts all over the country if you want to talk to someone that way. So we have a whole host of opportunities for you to get involved. But yeah, appreciate that, Rick.
This has been fascinating conversation, a unique investment opportunity and strategy that can help you demonstrate to your client you know a lot more about crypto than they do, and you can offer them opportunities to allocate to Bitcoin in ways that they've never even considered or thought of. And I think it's really worth a deeper dive. So, Matt, thank you so much for presenting this information. I'm happy to tell you that we've got a couple of other webinars coming up. Next week, February 11th, crypto and the Trump administration. What is in store for crypto relative to everything that Donald Trump is doing? That's going to be a fascinating conversation. And the very next day, on February 12th, how to generate lasting income for retirees without turning to annuity products. So both of those events are free. I encourage you to sign up for both of those events as well. And if you are interested in learning more about the spot Bitcoin ETFs, and the Ethereum ETFs, we've got a couple of toolkits that give you a quick comparison chart on all the ETFs that are available. There's the link to obtain them. My new white paper just came out last week, the 6 mistaken beliefs that are preventing you from buying and recommending Bitcoin. It's a quick read, fascinating documentation that'll help you overcome the objections and concerns that you may be having or that your clients may be having. The QR code gets you that free white paper so that you can see why you no longer should be sitting on the sideline and why the Calamos products may be something that you ought to pay attention to. And if you want to get more information about everything in the world of crypto, we offer the Crypto Catalog, comprehensive directory of everything available in the digital assets marketplace. It's free and available at our website at DACFP. You can also access it from the QR code right there. And our crypto conference Vision is coming up June 9 to 11 in Dallas. This is the oldest and largest crypto conference exclusively for financial advisors and accredited investors. We invite you to join us in Dallas with the latest and greatest of what's going on in the world of crypto. So we hope to see you there in Dallas. You can learn more about that event at dacfp.com. There's the QR code for you. And the ultimate is getting certified in blockchain and digital assets with our CBDA designation. 2 parts of this program, all of it online, self-study, take it at your own pace. The first part's all about the tech. The second part, all about integrating crypto into your practice management. Thousands of advisors and professionals from 37 countries have obtained their CBDA designation. It's the best way you can demonstrate to your clients that you have become proficient in this new asset class. And our upcoming conference in Miami, Florida, at the end of this month, February, not on just crypto, but on all of the investment strategies that you and your clients need today. I hope to see you there. It's a really power-packed conference with sessions no other event is offering. That's in Aventura, just outside Miami. And be sure to read my book, the #1 Amazon bestseller, The Truth About Crypto. Matt, again, thank you so much for joining us on this webinar. Terrific information, really helpful, and I think you're going to be getting a lot of outreach requests from advisors and investors.
Thanks for the time, Rick, and appreciate everybody jumping on.
Thanks, everybody. See you next time.